Hello, everybody, and welcome to the Dorsey Wright podcast for Wednesday, March the 4th. I'm Jay Gragnani.
And I'm Steve Raymond.
And this is the first podcast in the month of March. It's hard to believe March is here.
Yeah.
We were talking the other day about how long the month of January felt.
Yeah.
It felt like it was super long.
Right.
And then February felt like, despite having one extra day this year because of leap year, felt like it flew by.
Yeah.
And the volatility at the back half of the end of the month probably helped that
Right.
feel like it flew by a bit. Nonetheless, here we are in the month of March, and the market certainly still a bit volatile.
Yes.
And as we go back, this month rolling into a new month, the month of March, we closed out the last month last Friday, and it wasn't that long ago that we were sitting here doing these videos, and we're at all-time highs.
Yeah.
The S&P 500, February 19th, hit a new all-time high, and over the next 8 trading days, managed to see the biggest or the quickest 10% pullback off those highs that we've ever seen in the market.
Yeah.
And here we are, still off those highs, 10-ish% depending on the day,
Yeah.
or in this case, the market's case, the hour. It seems like things are changing quite a bit by the hour. And so, what I think we thought it would be worthwhile doing is just kind of taking stock of where we stand today with all of the news from the spread of the coronavirus. It seems like every day there's a new city, a new area that is reporting a case of it. That's been obviously the big headline. The headline of the Fed coming out yesterday in an off meeting in fashion, cutting rates in a big way. And then obviously you had the Super Tuesday election results from last night. So a lot of stuff going on, a lot of things that people are reacting to out there in the market.
It's called piling on. there should be rules against it, but definitely, JG. The market drop was not only fast in records as market historians would frame that, but many of us were here through many corrections over the years, and certainly we would also concede that this was very fast.
Yeah.
There have been some close ones in speed. A rule of thumb that maybe I tell myself sometimes is the faster the first drop, the better it will end up being. Now that doesn't work every time, but it
makes you feel better.
Yeah, you feel better that it's going to be a bull market more of a correction. Could be. Those fast drops are part and parcel of a bull market correction. I will point out that the asset classes that we monitor, we have several ways of doing it. One way would be through the asset class group scores page, where we score every asset class, that the integrity of the alignment of the equity groups stays stable. Mm-hmm. What I mean by that is that pre-market turbulence, large growth was the number one scoring, mid growth number 2, and you go on down through the kind of a roster, and you end up at small value being the weakest. And then we get hit pretty hard, several days, and a lot of turmoil up and down, and as JG pointed out, the other noise and the other piling on and the other fears that are in the market, and the asset class alignment is identical. Large growth still the number one scoring group, mid growth behind it, and small value in the tail. So you can take that basic information and say something like, the the equity asset classes really didn't change their alignment. They didn't rotate to something else that might be newly favorable and very different from what was favorable. And so you could make a conclusion that equity leadership, just concerning equity, has remained stable and intact. And that's actually a good sign as well. Obviously things could change. As people point out, things may change, but this is what we have. And so the asset classes are intact. Leadership in the equity alignments is the same as it was. The core strength is in the 78th or 79th percentile. That means that the S&P 500 ranks near the 79th to 80th percentile against all other asset classes around the world. I think that's an important point to make, bringing stability to the market. Many of our money market indicators, I'll point to one, which is the money market percentile rank, is running around 10%. It's up from 3 to 10. in the peak of the turbulence, and that kind of means that cash is not a dominant asset class, and that another way to say it is 90% of the world's asset classes are functioning stronger than cash and are functional to use in an asset allocation. So,
and that's, it's interesting you put it that way. 90% of other asset classes are basically above cash. And that's everything from equities to foreign equities to bonds to commodities, currencies. Not to say commodities are above cash today, because
some of
them are individual commodities, right? But at a large. And we sit here and just look, and the S&P's down 7% year to date. As we're filming this, and that could change. In terms of the leadership trends, it's interesting when you look down the roster. You mention it from kind of the asset class perspective, but even within equities, the style boxes still point towards the growth styles. Sectors as well. You're not seeing any real divergence of leadership changes. You saw financials take a hit the other day because of interest rates. But when you look at the top end of the spectrum of asset or sector performance this year, you see utilities up there, which has been a strong relative strength sector for a while. Real estate is up there, and technology is up there. Those are the same themes we were talking about last year.
Yeah, as we may have mentioned in prior media, is that low vol and utilities have been very helpful for 18 months, and we're quite welcome to take the help. Another vantage point would be that what you said, JG, is that the real assets haven't shifted. And my recollection, my experience, I'm sure your experience as well, is when the asset classes do not rotate and shift and go completely different from what you were working with, then that tends to suggest there's no need to change the game plan. You stick with the leadership that got us here. And I find that that's comforting, and so far that's exactly what we're seeing. I mean, you could say kind of what we're seeing. No, that's exactly what we're seeing, and we kind of stick with that game plan. And I know many of you do models. You put together things yourself, or you follow things that Dorsey Wright does, or you work outside with other fine purveyors and do things. But what we're seeing from the indicators is that, yes, we do understand there's fear out there, and I would say that you should have caution where caution is needed. But the models and the strategy, we're sticking with the leadership that got us into this month, which is March.
And just to kind of from a historical perspective, I mean, it's not 10% correction is not uncommon by any means. As a matter of fact, you go back. The past 20 years, you could go back the past 40 years, and the numbers kind of hold true in terms of we have seen a 10% pullback in the market roughly once a year. About once a year. I mean, that happens. It doesn't mean every single year it happens, but on average about once a year. Some years you might get two, some years you might get none. But if you go back and you look at the body of work, on average it's about 10%. And when you go and you look and say, okay, what is the drawdown? What's the pain that most people see during those time periods? When you go back and you look at the market, it's since basically 1950, the average pullback is about 15% from peak to trough drawdown. So, you hit that 10% and on average, you probably see another couple of percent pullback from there. But that is, just from a historical perspective, that is a rather normal pullback. Only one in four have led to 20% drawdowns. Have led to, so a 10% correction that leads to a 20% bear market only happens about 25% of the time when you get those 10% corrections.
That's a good point. And that's kind of what I would call it kind of a bias when you're thinking about strategy is, the odds are that you're going to have a bull market correction, and the odds are you have a game plan that addresses bull market corrections. That's the majority of what we'll face, as JG well explained. And then there are bear market scenarios. We have a game plan for that, and that you can unfold a game plan for bear market strategies, but they happen much less frequently. I think we wrote in the report, the correction, might be, like you said, those numbers you just read me, JG, maybe 15%, maybe it's 18, I remember there was a year where there was no correction. I can't remember the year off the top of my head, but it wasn't so long ago. And people called up and said, "Where's the correct?"
2017.
Yeah. They're worried.
Yeah.
There was a lot of worry about, hey, there's no, the market's not really correcting, getting healthy. So I just want to point out, as we all worry about many things, people, we all find something to worry about. And it just so happened in that year we're worried about it's too smooth. There is no correction. So often a market historian or others would say the corrections are healthy, they're needful. This helps, kind of reset prices and get things straight and kind of bring sobriety back to the market. And I think that clearly, you have that going on now. You could consider that a good thing, or you could say at least up to now that this is a good thing and this is helpful. It gives people a chance to to move in and rework the allocation, take advantage of opportunities in pricing. That are somewhat obvious here, and I will point out that all along the way of the event so far, some of the major long-term indicators barely even register that anything's going on. Yes, I do know that there are short-term indicators, and I do know that there are other shops out there that can say this and that, and I'm not really addressing that right here in this comment, but the long-term indicators are holding in nice and steady, and the scores of many of the great funds that you're working with now are holding up great. And so you can count that as a good piece of confirmation, confirming news that, hey, we're just still playing the game plan, and we're following basically, what are we following? Well, the same rules that got us here in the first place, and we're continuing to monitor for changes. And in many cases, there are no changes. I did see one change in an American funds model where what you call the fixed income type of funds got in for about a 40% stake into one of the American funds model, and that's kind of the biggest move I've seen. And some of you may say, "Wow, that is pretty big." But sometimes some of the models you work with do some things, and other models don't do other things. And I think there's a diversity built into that. I mean, that could be deemed helpful. I don't want to say that loading up on the American funds, bond funds is a mistake, and I don't want to say that it's the only right thing to do. But I will say that having some diversity helps. Remember, there were people I can remember way back, but I'll just keep it short. Even from 2012 and then to 2015, and all the fixed income aficionados, including Bill Gross, suggested highly that the fixed income market would stop operating normally. Be not a good play for asset allocation, and we basically evacuate the whole bond inventory. And you know what I'm saying, because you've heard this too for years. And quite frankly, this is a perfect scenario of I think last year, but let's say a perfect scenario this year of fixed income doing its hopeful and proper job inside an allocation. Absolutely. Where something over here doesn't work out so well, that works out really well, and the whole idea is counterbalancing the allocation by having some diversity of the asset classes. So I could say fixed income has acted pristinely textbook, even though for years some say or had said that it probably wouldn't do so. So you got to be in control of your game plan and kind of remember some of the classic rules, and don't count out a group simply because someone says it shouldn't work down the road. I mean, you got the technicals to guide you, and I could say that equity is holding in there really strong in this market, given all the turbulence, and fixed income certainly is strong too. So
yeah, I mean, as you were talking about that, I mean, obviously bonds, the market did phenomenally well last year, up.
Yep.
28, 29, 30%, depending on your index. Bonds did great.
Yeah.
Long bonds were up 12%.
Yeah.
Now, they didn't compete with equities,
Right.
but they were additive to the portfolio.
Yeah.
This year, long bonds, long U.S. Treasury bonds, TLT, is up 15%.
Yeah.
And that's obviously an extreme with rates being driven down as hard as they are, and but core bonds are up 4%.
Yeah.
So to your point, the correlation benefits have certainly proved themselves pretty well.
And people have different shops they like as purveyors. Like we could name all kinds of names, but yeah, I like American Funds runs very low volatility fixed income. Franklin runs classic fixed income. PIMCO runs high science fixed income. But all those shops are bringing to the table things that you would need. I would purport that you've always needed them, and you always will. But they certainly come in to play in last year when things were going really well. They're additive, which is a very, very good point to make. And then so far this year there's some turmoil, and really the fixed income's really helping you out.
Yeah.
So by evacuating or saying no, I don't want any part of those plans, you're actually hindering the ability for your allocation to function normally. So you want to consider that your game plan always has these individual pieces, non-correlated pieces certainly, because they come into great help. Even though some suggest at various points in the road that it won't work next time. Well, it wasn't supposed to work, but according for us in here, it just worked on schedule. Just doing the daily job that it always does.
Steve, back to your point earlier, you were talking about years that we didn't see a 10% correction, and the fear still being out there of what's going on, what's wrong.
Yeah.
There's not enough volatility in the market. And as such would have it that, the volatility will come back at some point.
Yeah.
But really, you go back and you look at, in 2015, you had one 10% correction, you had the start of another 10% correction.
Yes.
That almost led to a 20% move by the beginning of 16.
Yep.
Then 17, you didn't have anything. The volatility was so low that things just kind of plodded along. Nothing was up real big, in any one day or any one week, but things kind of plodded along. 18, you had two 10% corrections. And then 19, you didn't have anything either. Yeah. And so really, this is the first since the end of 2018, which culminated with that Christmas Eve, massive sell-off, and then the eventual recovery from the end there. And so I think there's a couple things there. Number one, that it's not unprecedented, as we mentioned earlier. What's different this time, though, is the speed at which it happened and the fact that it hadn't happened in over a year. So it had been a while since, investors, since we've really felt a pullback to this degree. And so I think it's worth taking a step back, adding some perspective, gaining a little bit of perspective. Okay, where, as a result of this, where are the indicators relative to where they were in other pullbacks and other market corrections and the likes? And so, looking at some of the data and making decisions based on where those indicators are now is extremely important as we go forward.
Yeah, I'd like to hop on that train with you, JG, is that what we do is we evaluate the data. We continually do so because we know that we don't, here in this shop, we don't forecast into the future. Yeah. We don't do forecasting. Maybe we kind of want to, maybe you want us to, but we don't do really well. We don't do really well maybe at wanting to do that. I think what we need to do, and certainly you should continue to do, is monitor for change. Change can come, and when the change comes, we make changes. That's kind of the simplicity of that game plan. I couldn't tell you how long we'll be in a mode or this mode or in the next mode. I can tell you that we look frequently, as you do. Our models run monthly, some weekly, but most monthly and then quarterly, and that we step in and step through different market eras that present different market situations. And so I don't want anyone to gain any comfort that whatever we're saying at this moment is good for a half year. How do I know? It's just this is where we are. The asset classes are holding up rather well under this turbulence, showing a kind of leadership is still in place. Many long-term indicators and other readings on relative strength are offensive. That's the case now, and most of our models are fully offensive. Mm-hmm. That is the case. That is the what is of that matter. And I don't want to say all that and kind of take away from the story that maybe people are very concerned. Maybe there is a concern about a growing concerns in America and around the world. I don't want to take away from that. I think you should be monitoring all the things you do, and and monitor these indicators. For example, we teach our models not to pay attention to things that we don't want it to pay attention to. So our models don't watch the news. We don't have a TV in front of the model server. It's a rules-based system. We go with positive trends, we go with leadership, and if those things change, we change to where that positive trend and leadership is. And I think we need to tell you that, because I don't want you to think there's any kind of forecasting or other kinds of magic that are going on. Again, I say that not to take away from the panics and the worries that are there. As you all know, markets do climb walls of worry, so worry's not always a bad thing. But yeah, you have to have a game plan. You have to be able to tell your client, here's what we're doing, and I'm going to walk you. You're saying to the client, I'm walking you through this. I'm here. Some people look at it this way. We were in February, and the next seasonal quarterly update for, let's say, fund score models is May. We got to get to May. We got to. You make a contract with your client. I'm going to walk you to May, and we're going to make the right moves and do the right thing. And one right move might be we don't do anything about it. We just ride with it. Another right move might be we need to make an adjustment. So it's something to consider, is that this idea that we need to react hourly and every half day to what's going on in the world. That usually is a losing game plan. It certainly makes rational sense that, but it usually is a losing game plan in the investment kind of community to be changing our minds every half day. Yeah.
I think that's, at the end of the day, sticking to your game plan is important regardless of the market environment, but probably more so important today, when the bullets are flying, right? When the markets are volatile, when things are getting uncertain, when your clients have a lot of uncertainty, is revisiting, reassuring, going back to that game plan and say, here's what our game plan is. And if things start to change, we'll make those changes along with it, to your point, as you mentioned earlier. If we're sitting on the sidelines, we've got some indicators that we look at, or you're wondering when we want to put some money back onto the table, if you raised cash earlier on or whatever it might be, based on some shorter term indicators like bullish percents or any of that kind of stuff. There's a way to approach that in a disciplined way, instead of trying to catch a proverbial falling knife. Because we get questions now of, hey, should I be buying this dip? Is this a dip I should be buying? And the answer, I think, always comes back to, well, I want to see some confirmation that a bottom has at least been put in. And to this point, from those short-term indicators that turn negative are now in pretty oversold territory. Let's watch for some confirmation. Let's get some confirmation. We're not going to try and pick the bottom, and that's not our game. That's not what we want to do. But we want to provide some confirmation that at least a near-term bottom has been put in, whether it's a bullish percent reversing up, whether it's things like high-low indicators reversing up, whether it's the chart of a stock reversing up. And you know what? If you go in and you buy a stock and you say, I think the stock is bottomed, that chart reverses up. It gives you a pretty tight stop at that next sell signal, if the market proves you wrong. And so, those are just some things that we're kind of looking at today, but sticking to that game plan, Steve, like you mentioned, I think is so important, especially right now.
That's excellent advice, because although I would say, I would say this ain't easy, but it's doable, meaning that, you go and pick the things you need to do and the adjustments you may need to make, or that you want to make. But JG pointed out great advice. We've got indicators that are washed out. If they reverse up, that's a little bit more evidence that we're in good shape. I mentioned some of the long-term indicators are in good shape. Hope they, that's where they are. That's the what is. And so you do have some ammunition to get in there and convince comfort the client, convince the prospect, hey, you guys stick with me, is what you're saying. And you're going to walk through this with a way to handle it. And then we'll keep monitoring. But I think you pointed out, JG, that most market disturbances end up being bull corrections, which end up going away, which end up being great opportunities. So the majority is already in your favor. The odds are, let's say that's what this is. And so without forecasting anything, just say, go with what is. Go with the rules in place and the evidence of the indications that are in place.
Yeah. Well, Steve-O, there's not a lack of things to talk about in the market for sure. We could sit here and talk for hours about things that we're seeing, just historical perspectives on the market. But with that said, we'll see in the days and weeks ahead to see if things start to change, if some of the long-term stuff begins to roll over, or if some of the shorter-term stuff begins to reverse back up. Nonetheless, we know the operating system that we're working with. And so with that, as always, we try and keep you up to date through these podcasts that we produce every Wednesday. For those of you who log into our website through our daily equity report and then through our Monday videos. So, trying to be out there with as much content, with as much perspective on the markets as we can. So with that said, Steve, appreciate you joining us this week. Everybody listening, appreciate you, as always, listening to us, listening to hear what we have to say about the markets. Hopefully it's helpful. If there's topics that you'd want to see or hear more about, please let us know. Feel free to reach out. But otherwise, appreciate you joining us. Look forward to talking to you next week.